A car looks like a product. It has wheels, a price sticker, a warranty, and that new car smell manufacturers have somehow turned into a personality trait. But inside the modern auto market, the car is only the beginning. The real business can include the loan, the interest, the dealer add-ons, the insurance products, the connected services, the data, the repair network, and eventually the next trade-in. The vehicle gets you to work. The payment system keeps working long after you arrive. And that is why your car is becoming a financial product. Start with the number most buyers are trained to watch, the monthly payment. A dealer can make an expensive car appear affordable without lowering its price. The loan simply lasts longer. 72 and 84-month terms stretch the same purchase across more paychecks. That can lower the monthly number. It can also increase the total interest and keep the borrower exposed to depreciation for longer. The Consumer Financial Protection Bureau puts the trade-off plainly. Longer loans may reduce the payment, but they increase total cost and the risk of negative equity. Negative equity means the loan balance is larger than the car's current value. Cars normally lose value as they age. Loan balances also decline, but not always at the same speed. Add a small down payment, a long-term, taxes, fees, warranties, and a high interest rate, and the borrower can spend years owing more than the asset is worth. That would be inconvenient if people always kept cars until the loan ended. Many do not. Repairs appear, families change, fuel costs rise, a job requires something different, or the dealership offers to put the buyer into a newer car while keeping the payment close to the old one. The old debt does not disappear. It can be rolled into the new loan. Now the next car begins with yesterday's unpaid balance attached. The CFPB Auto Finance data work found that borrowers financing negative equity tended to face larger loans and higher payments. The new vehicle is carrying two transactions, the car being purchased and the car that failed to pay for itself. This is where the industry stops looking like a simple market for machines and starts looking like a machine for renewing debt. The customer does not have to buy a car every 3 years, but a system built around monthly affordability makes replacement feel easier than completion. The question shifts from, what does this car cost? To, can I handle this payment? Those are not the same question. Imagine a $45,000 vehicle financed for 7 years. The payment might fit a household budget today, but the loan is now competing with rent, groceries, childcare, savings, and every future surprise until well into the next decade. The price is visible once. The payment is felt every month. Financing also creates room for extra products. Guaranteed asset protection coverage may be useful when a borrower owes more than the vehicle is worth. Service contracts may reduce the risk of a major repair. Tire protection, theft products, appearance packages, and other add-ons can each have a legitimate customer. But when an add-on is folded into the loan, its price also earns interest. A $2,000 product is no longer only a $2,000 decision. It becomes a small increase in a payment repeated for years. That is the magic of payment-based selling. Large prices become small increments. Then comes the digital layer. Cars increasingly contain software, connectivity, navigation, driver assistance, entertainment, remote controls, and app-based features. Some require real, ongoing services. Cellular connections, map updates, cloud processing, and support are not free to provide. But the financial attraction is obvious. The old automaker sold a car and waited years for the customer to return. The connected automaker can maintain a paid relationship during the entire ownership period. The vehicle can produce purchase revenue, financing revenue, service revenue, subscription revenue, and data value all before the next sale. That does not make every loan abusive or every subscription unreasonable. Financing lets people get to work when they cannot pay cash. A longer loan can be rational for a durable vehicle at a low rate. Gap coverage can protect a genuinely exposed borrower. Connected services can deliver real convenience and safety. The problem is evaluating each decision through the monthly payment alone. Here is a better test. First, calculate the out-the-door price before discussing financing. Second, compare the total amount paid across loan options, not only the monthly number. Third, ask when the loan balance is likely to fall below the car's value. Fourth, price every add-on separately and include the interest it will accumulate. Fifth, ask what still works if the connected subscription ends. And finally, decide how long you realistically expect to keep the vehicle. The best financial version of a car is usually boring. A price you understand, a term short enough to see the end, a payment that leaves room for maintenance, and enough years without payments to recover the cost. The most profitable version is more exciting. A new vehicle before the old debt is finished, add-ons hidden inside a monthly number, and a digital relationship that never really ends. There is one more reason to separate the car from the financial product. The consequences of failure are different. When a household falls behind on a television payment, it loses access to credit and may face collections. When it falls behind on a car, it may lose the machine that makes work, childcare, groceries, and medical appointments possible. The CFPB reported more than 100 million active auto finance accounts and over $1.6 trillion in outstanding balances through the third quarter of 2024. That scale matters because auto debt is connected to income in a way many other consumer loans are not. Repossession is not simply the return of a product. The borrower may still owe money after the vehicle is sold. Transportation disappears at the same moment credit damage and a deficiency balance can arrive. That makes the original purchase decision a resilience decision. A payment that fits during an ordinary month may be too large during a layoff, illness, or repair. A household with a cheaper vehicle and a maintenance reserve has two forms of protection. A household with the maximum approved payment has one expensive dependency. Dealership financing also deserves its own comparison. The interest rate offered in the showroom may be convenient, but it should still compete with a bank or credit union pre-approval. The vehicle price, trade-in value, loan rate, term, and add-ons are separate negotiations even when the paperwork combines them. Unbundling the deal removes the fog. Write 5 numbers on one page: the cash price, taxes and fees, trade value, financed amount, and total of payments. If the explanation requires hiding one number behind another, the deal is not yet clear. And remember the part the showroom cannot display. The most valuable months of a car's life may be the months after the loan ends. During those years, the vehicle is still providing transportation while the financing product has stopped collecting revenue. Keeping it safely on the road turns depreciation into utility and converts an old monthly payment into savings, repairs, or freedom. That is the financial destination the renewal cycle quietly postpones. The car gets older. The financial product renews itself. This is price tag theory, the money behind everyday life.